exchange funds sound great because they offer you diversification without having to sell any of your stock and incur that taxable gain.
Right.
Like, great. This is like, the best of everything. Have your cake and eat it too, as it were.
Right.
Although I recently learned that Marie Antoinette did not actually say that. She said that people could have their brioche and eat it too. Anyway, I know.
Blowing my mind.
And nothing I've just said is wrong. It is just too simplistic a description to fully understand how it would work for you.
Mm-hmm.
And again, going back to what I learned from good old Mr. Coaches, is this offer, this promise of diversification is way less persuasive than it sounds, because these exchange funds are usually formed when a particular industry is doing really, really well. And right now, the last few years, tech has been doing really, really well. So my client, let's say she works at Airbnb. She doesn't work at Airbnb. She was invited by an exchange fund to, hey, do you want to put some of your Airbnb shares into this exchange fund?
Mm-hmm.
The message, this sort of tacit message being, because we already have shares from all these other tech companies in there, probably NVIDIA and Meta and Amazon and Microsoft and blah, blah, blah. And so you will go from owning $1 million worth of just Airbnb to $1 million of combined Airbnb and Meta and Facebook, well, whatever, all those tech stocks. Right. So yes, you are getting some diversification. You're diversifying away from the idea that your one company might flail, might falter.
Right.
But you're usually not getting any industry diversification.
Yeah.
Right. So if the tech industry does poorly, you're still poop out of luck. I don't know if we're cursing or not.
It's a good question to ask, because to your point, if we go bigger picture for a second, the exchange fund, to your point, what I'm hearing you say is, okay, I have $1 million of Microsoft and it's way too big of a percentage for me, but the basis is so low on this, I really don't want to sell it. Right. And in my head, I want a different solution. So the exchange fund is a potential solution. And at the exchange fund, I'm going to put in my $1 million of Microsoft, and a bunch of other people are going to put in other shares as well from different companies to diversify us, is the idea. When we do that, I stop owning the $1 million of Microsoft technically, and I could technically get my money out faster if I needed to. But what normally happens is there's, to get a special tax treatment to help reduce my capital gains, we need to hold that position for at least 7 years. So I basically am illiquid for 7 years is one way to think of it. So I need to be okay with that.
Yep.
And then while those funds are there, the idea is, to your point, the benefit is I got rid of unsystematic risk, right? I got rid of the risk of just having my money in Microsoft. Now my money's in all of these tech stocks. But I probably, to your point, I probably didn't get broad diversification that I would have gotten had I just sold and gone into a more traditional portfolio.
The promise of diversification, I think, is just oversold. I mean, you can find out what the other stocks are in this exchange fund, so you can judge for yourself whether it's, only mildly diversified or really broadly diversified. But typically, it's not going to be very broadly diversified outside of the sector that your stock is already in. So it's a minor benefit that I think maybe is sometimes pitched as a much bigger benefit. And the other thing that I was reminded of is, again, there are all these tax rules that the exchange fund has to follow in order for you, the participant, to get these tax benefits from it. And one of them is 20% of the money in the fund has to be invested in an illiquid holding, and that is usually real estate. And I'm just going to read a favorite quote from Mr. Tim Coaches. He writes, "Excellent real estate opportunities can be packaged and sold on their own merits. Real estate used to meet a tax requirement for the packaging of some other main event, which is to say, this exchange fund, isn't likely to be the kind of real estate with the very best investment characteristics."
Yeah.
So, it's a very respectful way of describing it. But what he's saying is this is the crap that they can't sell on its own merit. So they're just going to shove it into this fund where you're not likely to really evaluate it on its own merits.